I think one way to view what's happening is Michael Saylor is effectively saying the world is getting ready. We're transitioning away from gold. We're sort of demonetizing gold, and now we're going into Bitcoin. If you believe by the year 2050, Bitcoin is going to be extremely important in the global financial system, and that gold is going to be kind of a, remember when gold used to be a thing? It might be like how I'm sitting here telling you, oh yeah, silver used to be a thing. And so the US government can get ahead of that and kind of jumpstart that process because the US right now controls so much of the world's gold.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am going to parse the recent suggestions coming from Michael Saylor that the US government ought to, for one thing, establish a strategic Bitcoin reserve or SBR. But beyond that, he's, I think, more recently added the twist that, hey, and it could even be, quote, free in the sense that they can just sell off their current gold holdings. And that way, it's not adding to the deficit or requiring more tax revenue. It's just an asset swap. And he thinks that that would have more than one benefit from the U.S. perspective. So why don't we go ahead and, we'll play a short clip from Saylor so you can hear it in his own words, and then I'll spend the balance of this episode just kind of unpacking all that and giving you my thoughts on the intriguing proposal. So here's Michael Saylor.
Bitcoin is emerging as the world's reserve capital network. People are realizing that Bitcoin is better than real estate. It's better than stocks. There's not a single company or real estate property that you would rather own for the long term than Bitcoin. So the very simple idea is buy 20 or 25% of the Bitcoin network on behalf of the U.S. government, catalyze the development of that world reserve capital network, and then let all the Chinese and the Russians and the foreigners sell all their other assets and buy Bitcoin, and then the money flows into the United States. If you want to put a great twist on it, dump your gold, sell all the U.S. gold, buy Bitcoin, then the trade is free because you could buy 5 million Bitcoin for the cost of the gold. You will demonetize the entire gold asset class, and our enemies hold gold in their banks. So their assets would go to zero. Our assets would go to $100 trillion, and we would control the world's reserve capital network as well as the world's reserve currency network.
Okay, so there you have it. Let me approach this now in a few waves. And as always, folks, with these things, or not always, but as is usually the case, put it that way, there is an accompanying blog post that I'm putting up at the Infineo website. This is episode 68 of the InFi podcast. If you go to the show notes of this, it will take you right to this link if you want to see me type this stuff out and have these thoughts in a written form for you to peruse. So for sure, let me just cut to the chase. I think if I were advising a company, just, as like an economist, and they hire me for consultation and just say, hey, right now we happen to be sitting on a bunch of gold. What do you think about, and no Bitcoins, what do you think about us diversifying? I would say, oh, absolutely. Like just in terms of financial management, portfolio management, diversification. Yes, I personally am bullish on Bitcoin. We here at Infineo, it's not our place to take a stand on it, but a lot of the people who work for Infineo happen to be very bullish on Bitcoin as well. And so I think Saylor's instincts are correct. And to the extent that we just viewed the U.S. government as an entity that owns a bunch of assets, and how can it rearrange its current holdings to be more profitable over the next 10 years, then yes, I think selling off a large chunk of its current gold holdings and supplementing it with Bitcoin makes a lot of sense from that perspective. So I think Saylor is correct that if the U.S. government sold off a bunch of its gold, that would hurt a lot of other governments around the world that are currently sitting on a bunch of gold as part of their reserve assets. And so, yeah, he's right. If other things equal, the U.S. government starts dumping gold, that's going to push down the world price of gold, and that's going to hurt people who are holding gold. But for me, that's not really a reason to do this, right? That's not like an added bonus to this. For one thing, there's lots of gold bugs holding gold, and they're going to get hit as well. So it's not simply that the only people you're hurting are people that Michael Saylor thinks the U.S. government should have animosity towards. But beyond that, just, given my views on diplomacy and so forth, I don't think it's a good idea for the U.S. government to go out of its way choosing policies that it says, oh, and an added benefit of this is that's going to hurt all these other people over here. Like, to me, I think that's not the right way to proceed. But put that aside. For the balance of this episode, let's just go through the economics of it. George Selgin, an economist that we've interviewed here on the podcast, a monetary economist that is a fellow traveler of the Austrian school. He doesn't refer to himself as an exact member, but he and I have very similar views in a lot of respects. He has been sharply critical, not just of Saylor's particular stance, but in general, this idea that has been making the rounds, especially since the Bitcoin conference. I think at this point it was like back in the summer of 2024 in Nashville, where Trump and Senator Loomis and RFK Jr. were all giving different versions of a proposal for the U.S. federal government to start stockpiling Bitcoins. And so Selgin has come out sharply critical of those proposals. And I'm going to link to Selgin's 2 posts that I've seen on this topic. And I think they're worth reading. Ultimately, I don't completely agree with George, and I'll, in this episode, explain why. But I think even if you are a huge fan of Bitcoin and want the U.S. government to start stockpiling it, if you're really a nerd and into this stuff, it's really helpful for you to go read George's post, because he gives a lot of background detail specifically on why do governments or central banks hold foreign exchange reserves in the first place? Like, what function do they serve? And you kind of need to know that to then be able to answer the question, is it a good idea for the U.S. to sell off some of its current reserves that are in the form of gold and replace them with Bitcoins? Again, you kind of need to know what function is that gold serving. And so where George is going to come down on this issue, just to kind of end your suspense, he's going to argue that at this point, the U.S.'s gold holdings don't really serve any strategic function. They don't in any way underpin the strength of the U.S. dollar. And so it doesn't really make sense to say, oh, we'll further buttress the dollar strength if we put in what we believe to be an asset that's going to have a higher appreciation, namely Bitcoins. George thinks you're misunderstanding what the gold is doing right now. And his conclusion is going to be, I don't mind someone who says, let's sell off the gold, but instead of the taxpayers implicitly allowing the U.S. government to go be a hedge fund manager on their behalf, just give a tax cut to everybody, or give a lump sum rebate to everybody from those gold holdings and the revenue raised from the gradual sale. He also says you don't want to dump everything next Tuesday, because that would crash the price of gold. But he's saying like a gradual sell-off that's perhaps announced ahead of time and everyone knows what the schedule is going to be so the prices can adjust in an orderly fashion. He thinks that makes sense. But again, he doesn't want to swap it for Bitcoin because he's saying the US dollar doesn't have anything to do with these assets at this point. So that's kind of a side issue. And then just in general, as taxpayers, would we want the US government running like a sovereign wealth fund on our behalf? No, why would we? So to be clear, George is not anti-Bitcoin, but he's saying, if you think Bitcoin's a good investment, then go ahead and invest in it. And you can go buy more of it yourself if the U.S. government were to sell off its gold and give you your quota of the rebate if you're a U.S. citizen or a taxpayer, however they figure out how to give that money back to the people. So that's his stance. So I don't have a huge problem with that, but I do want to walk through George's analysis because there's one critical point where I do think he's being a bit unfair to the proponents of this idea. Okay, so when all is said and done, I think you're going to understand these issues a lot more if you read George's post and my post, or if you just listen to this episode where I'm going to hit some of the highlights of both. But again, I wanted here at the front end to just tell you what the answers are going to be so that I'm not losing you along the way and that there's no keeping you on the edge of your seat and wondering who done it. Okay, so historically, governments around the world, I'm going to go back even further. I was going to say tie their currencies to gold, but I'm going to go even back further. The U.S. government and many of the other major powers as well had a long period of what was called a bimetallic standard, BI, meaning D2. The U.S. dollar was defined in both terms of gold and silver. It goes back to at least the 1792 piece of legislation in the newly formed United States under the Constitution in its current form after the Articles of Confederation. And there, it was a precise weight. There was grains of pure silver and pure gold that were in a 15-to-1 ratio to define the metal content of the U.S. dollar. All right, so I want to be clear, at this early stage, it wasn't that the US government printed green pieces of paper that were denominated in terms of $1, $10, $20, and then they had gold or silver in a vault somewhere backing it up. That's not what it was. No, they just said the dollar is defined in terms of both silver and gold according to these ratios. And then anybody, not just the Bank of France or something, but Joe Schmo can just go to the US Mint with a bunch of raw silver, hand it over and say, turn this into $1 coins that are official US legal tender and coinage. And then they would do that and they would stamp it into $1 coins and give it back to Joe Schmo. And likewise, if you had raw gold, you just hand over lumps of this metal, this yellow metal, and you'd say, turn these into $10 gold eagle coins or $20 double eagle coins. And they would go ahead and do that. Mint would obviously charge you a little bit of a fee, but that was the idea. Okay. And so at that early stage, and that was true from 1792 up through the eve of the U.S. Civil War in 1861. Again, the U.S. federal government did not issue paper money. It was just the people, in a sense, determined how many U.S. dollars were in circulation in the form of gold and silver coins that were the official legal tender money. Now, banks could issue paper notes that could be redeemed in what was called specie. That's like the physical metal, the real money, the genuine article. Okay. And so for matters of convenience, like if you had a large purchase, you might go and buy a piece of land and hand over high denomination bank notes issued by some reputable bank that, the notes were hard to counterfeit and such. It was banks that fulfilled that role in terms of supplying the public and the merchant class with the forms of money or money claims that they wanted. Okay. What's interesting is it's relevant to what we're talking about with Bitcoin now, because so what happened was, let's abbreviate some of the story here. When the 1792 legislation was codified, gold really was about 15 times more valuable than silver in terms of global market price and in terms of their physical weights. Okay. And so that's why the framers of that legislation picked that ratio. They weren't trying to do something fancy. They were just trying to reflect economic reality at the time. And the reason also, I should mention, they had a bimetallic standard. The reason they defined the dollar both in terms of gold and silver is they wanted to encourage the public to have coins of both types, because the idea was for large purchases, something that costs $50, it would be good to just say, oh, here, I've got 2 double eagles and a gold eagle, right? So just 3 coins can convey the amount of physical gold necessary for that $50 purchase. But then for something that only costs $0.25, that would be way too little gold physically to have in one coin to be $0.25. So instead we use silver, because you need a lot more. You need 15 times more silver in terms of weight to convey $1 than you do of gold. And so $0.25 in silver, that's not going to be too small in terms of the metal. So there's silver $0.25 floating around, coins that are stamped as their $0.25. And then, of course, eventually just call them quarters, or they're 25 cents, like 25%, in case you never, it's obvious once you say it, but in case it never occurred to you, why do we call those things quarters, or why are they 25 cents? That's why. Okay. Dimes and so forth. Originally, there were not dollar gold coins. That would be too little gold, right? Instead, for the smaller denominations, those were just in silver. Okay. So that's why they defined the dollar both ways, because they thought that would be convenient for commerce if people had access to both types of coins. What happened, though, is because of silver discoveries after that 1792 legislation was enacted, the production of silver outstripped gold. And so the world price of silver fell such that gold became more like 15 and a half times more valuable than silver. And so now, because the official US dollar definitions had gold being only 15 times more valuable, what's called Gresham's Law kicked in. And so now everybody just did their commerce in terms of silver in the United States. So for a period, if you had to buy something, and particularly if you owed somebody money that was denominated in US dollars, you would just pay them in silver coins. You wouldn't pay them in gold coins. That would be silly, right? Because the silver was effectively being overvalued relative to the dollar than the gold, when the gold was being undervalued, right? And then they changed the definition of the gold dollar. They reduced its content. So they flipped it. And so then it ended up being that the definition implied that gold was 16 times more valuable than silver. It wasn't exactly. Originally, it was exactly 15 to 1. And then with the new definitions, it was like just shy of 16 to 1. But then they had the opposite problem. So now gold was being overvalued by the official US dollar definition because the world price was still close to about 15.5 to 1. And so now it flipped. And so Gresham's law went the other way. Gresham's law being the aphorism, bad money drives out good. Okay, or more accurately, it's if the government overvalues a currency, the people will pay their debts off with that form of money. And if government regulations undervalue a type of money or currency, people will hoard that, right? That's more accurately what Gresham's law was capturing, but you'll hear it just said bad money drives out good. Okay, so again, once officials fiddled with the definition of the gold dollar, they overshot. And so now gold was overvalued in terms of its definition of the dollar. And so now anybody who owed dollars to anybody would just pay with gold coins or financial instruments that were denominated in terms of gold. And so then in this period, when nobody was bringing raw silver to the mint to be turned into coins, silver gradually got demonetized. Right? So there was waves of legislation that phased out the ability to strike new fractional dollar coins of silver. And then ultimately in 1873, they did the last nail in the coffin. And from that point on, you no longer could coin a silver dollar. That was discontinued in 1873. And so at the time, there wasn't a big fuss because, again, given global prices, it was uneconomical. It made no financial sense to take raw silver to the U.S. Mint and have them stamp it into silver dollar coins. The amount of silver physically you'd have to hand over that they would then turn into a disc that had stamped on it $1 US in terms of official US coinage, that lump of silver was worth more than $1 US abroad in terms of its just bullion melt value, right? So that's why nobody would take raw silver and have it converted into US coinage because you could get a higher price for it elsewhere, right? Just in the open market, okay? So that's why when the US government discontinued the ability to turn raw silver into coins that were official US money, there wasn't much of an outcry. But then later on, more and more governments followed suit and went on to just a monometallic gold standard. And so ultimately, leading up to the eve of the First World War, all of the major powers, something like 40 plus of the biggest countries in the world, all tied their domestic sovereign currency to a specific weight of gold, right? So the French franc, the German mark, Italian lira, the US dollar, British pound, as of 1912, let's say, each of those, their central banks or governments, depending on whatever the institutional setup was for a given country, anybody could go in, hand over notes of their sovereign currency, whatever the money was in that country, and say, give me a physical weight of gold, and they would do it. And so then that system is what we refer to as the classical gold standard. But what I'm pointing out, though, is the gradual shift of the world away from bimetallic standards into a monometallic, just gold standard, effectively meant that country after country started demonetizing silver. And so what that was doing is it was releasing a lot of silver that had been held for monetary purposes just into the general market. And so what that did is it pushed down the global value of silver such that now gold was more than 16 times as valuable as silver in terms of their relative prices on the global market. Okay. And so now in the United States, once again, as the world gradually demonetized silver and silver prices fell, at some point, all of a sudden, now given what had been the official minting price of silver, we would like to take raw silver to the mint and have it turned into dollar coins, please. And no, they discontinued that back in 1873. Right. And so that then was referred to as the crime of 73, which you may have heard of. Okay. And then this stuff, I'll wrap this little historical aside. I'm going to get back to the Bitcoin stuff, folks. But you may have heard William Jennings Bryan in the 1896 Democratic Convention. He ended up being their presidential nominee. And he gave this famous Cross of Gold speech. And what they were calling for is a restoration of the free coinage of silver and a return to a bimetallic standard. Okay. And if you know about Bryan's politics, he was a populist. He was a man of the people. So the resumption of the free coinage of silver would have effectively allowed for the creation of a lot more dollars. Silver would have been, that was worth a certain amount, would have been transformed into coins that had a higher official value. and the coins would be worth more than the bullion value of the silver contained in them at this point. And so that would effectively be inflationary. And so it would allow farmers, for example, who had mortgaged their farms, and the mortgages were held by the big bankers on Wall Street. So now you owe them debts denominated in US dollars. The resumption of the free coinage of silver would allow you to take relatively cheap silver, turn it into the form of silver coins that have a higher dollar value than the raw silver did, and then go pay your debts down that way. So it would allow the farmers to more easily service their debt. In general, it would just cause inflation and cause prices to rise. So if you're a farmer with a fixed dollar debt and then prices start rising, that's going to help you, right? Because you're selling eggs and milk and beef and so forth and pork. And so rising prices, those prices are going to rise, but the amount you owe the bank because the mortgage you took out on your farm is going to be fixed in dollar terms. Okay, so that's kind of just the background there. So maybe I'm giving you to fill in some of the gaps of U.S. history. If you want to read more about this stuff, my book, Understanding Money Mechanics, that's published by the Mises Institute, is where you want to go. Just Google my name. There's free PDF. It's good stuff. Okay. Last thing I'll say, just because the movie Wicked is in the news so much lately with their marketing blitz, the original Wizard of Oz, including the movie that we think of, with Dorothy and so forth, the author, Frank Baum, of that story, many people think was using it as an allegory for these battles over gold and silver at the turn of the century. And so the Yellow Brick Road is gold. The Wizard of Oz is OZ, like ounces of gold and silver. The Wizard's a fraud. And Frank Baum was pro-silver and anti-gold. And so the lesson, what happens in the movie or in the story, Dorothy originally thought she needed to follow the Yellow Brick Road and have the Wizard of Oz fix her problems. And it turned out all along, no, the shoes she was wearing were the solution. Now, in the movie, that somewhere over the rainbow and that we think of, Judy Garland and such, she has ruby red slippers, but that wasn't the original story. The book, and then there was a stage production before they made a movie out of it. She had silver slippers on. I think for the movie, they just used ruby red because that was more visually appealing. All right, but in the original story, Dorothy realizes, oh no, the Yellow Brick Road is this fool's gold, no pun intended. It's the silver slippers. So all along, Dorothy had the power to go home and to rescue herself, right? So the claim is Frank Baum is trying to say that, no, we don't need to embrace gold. We can just rely on silver, and the farmers and the people have the means to sustain themselves. We don't need to go to these Wall Street fat cats and beg for favors. Okay. So anyway, back to the main story here. I think one way to view what's happening is Michael Saylor is effectively saying the world is getting ready. We're transitioning away from gold. We're sort of demonetizing gold, and now we're going into Bitcoin. And just like, hey, look what happened before. You didn't want to be sitting on a bunch of silver when the world went away from the bimetallic standards and then focused on gold, and those with silver were left holding the bag. Likewise here, the train's leaving the station, right? I'm putting in words here, and I don't know how much Michael Saylor knows about the bimetallic arguments. I'm relating what he was talking about to this history I just walked you through. And so that's one way to think about it, that if you believe by the year 2050, Bitcoin is going to be extremely important in the global financial system, and that gold is going to be kind of a, oh yeah, remember when gold used to be a thing? It might be like how I'm sitting here telling you, oh yeah, silver used to be a thing. And there was a big political battle over it in the late 1800s and early 1900s, but effectively, gold won. Whether you think that's a good thing or a bad thing, it won the day, and silver was no longer, even though it's a nice thing to have, and maybe some people make a lot of money investing in silver and speculating, whatever, certainly silver did not play a role in the 20th century financial system the way gold did. Okay, and I think that's one way to interpret what Saylor is saying is going forward, Bitcoin is going to be their strategic asset, not gold anymore. And so the U.S. government can get ahead of that and kind of jumpstart that process, because the U.S. right now controls so much of the world's gold that it could almost be a self-fulfilling prophecy. Okay, so now back to George Selgin. What is his alternative perspective on this? So he, in his post, reviews, and I'll just hit some of the highlights here, what function historically did these foreign exchange reserves serve? So one thing is, back when, during the days of the classical gold standard, clearly, if the French authorities are going to back the franc up by a certain weight of gold, the German mark, the British pound, the US dollar, they're all backed up by various weights of gold. The only way you can do that credibly is if you're sitting on stockpiles of it, right? So if you say right now the US, like I'm rounding, but it was basically the US in the pre-World War I era, if you turned in $20.67, that would get you 1 ounce of gold. And that should give you an idea of how much the dollar has lost in purchasing power, that back then $20.67 could be exchanged for an ounce of gold, okay? Whereas now you got to spend a lot more than that to get an ounce of gold in terms of US dollars, okay? And so how could the US government maintain that parity? Well, it had to have huge stockpiles of physical gold. In case people did show up and present US currency, they had to give them the gold. Otherwise, nobody would believe that peg, okay? And likewise for all the other powers. Incidentally, in case you're wondering, well, why would they do that? And it seems like it kind of ties their hands. And we know that, right? That now that governments have broken free of the shackles of the classical gold standard, they're going to be very reluctant to go back to it, right? If you have a printing press, other things equal, you would like to be able to do whatever you want with it. You don't want external rules saying, oh, yeah, you can print up US dollars with this printing press and it's legal tender money, but you also have this constraint that anybody who shows up with $20.67 worth of it, you got to give them an ounce of gold. That's like your pledge to the world. Okay, so originally, in order to get people to accept these national currencies, that's what they did. Like I said, originally the US dollar was literally defined in terms of gold and silver content. It wasn't like the dollar was this independent thing, and then to kind of bolster public support for it, they backed it up with precious metals. No, again, the dollar originally was born as being defined both of these ways, sort of like a foot was defined as 12 inches. It's not that they gave the foot inch backing in order to bolster public support for that unit of measurement. That's not even the right way to think about it, okay? So again, from the beginning, people were, well, put it this way, the idea of what we mean by a fiat currency was so anathema and foreign to people before the 20th century. Ludwig von Mises, in his great work, the English translation of the title is The Theory of Money and Credit, which came out in 1912. Mises had a taxonomy of the different types of money. And there was like a commodity money, which is just, there was an original commodity that then turned into a money like gold or silver or tobacco or whatever. And then there was credit money, which was money that had been a commodity, and then there were claims on it. And then like during a war, it was temporary, specie redemption was temporarily suspended, but people thought, oh no, eventually the government's going to go back on the pledge to redeem. So that's credit money. And then the third hypothetical category Mises conceded was what he called fiat money. And he said he wasn't sure that it had ever existed in history to that point. And he said, but we must concede the logical possibility, like in terms of his economics framework and how value worked and was subjective. Mises was admitting, as of this 1912 work, that we must admit it's theoretically possible there could be such a thing as fiat money, even though historically he didn't think it had ever existed. Okay, so to be clear, when you say, well, wait a minute, weren't there greenbacks and stuff during the U.S. Civil War and not worth a continental and thing, weren't there paper money inflations? Yes, but even there, Mises thought in all of those cases that he had studied historically, the public believed eventually being able to redeem the paper currency in terms of gold and or silver, that was going to come back once the war was over, whatever the crisis was. So that Mises was calling those things credit money because he thought, anyway, you get the idea. So my point is just to underscore how foreign to people the idea that we take for granted now that, oh yeah, money isn't backed up by anything. It's just the government issues it. You can't redeem it for anything and it just kind of is what it is. And yeah, if the government prints too much of it, then prices rise too rapidly. That would have been shocking to people. For example, in the 1930s, the early 1930s, when the British government formally went off the gold standard, just because of the economic conditions, not because they were in the middle of a war or something, the head of the exchequer, that's the right way to pronounce that, said, this is the end of Western civilization. That's how much he thought, what are we doing? What do you mean we're going to stop redeeming the pound in terms of gold? What are you talking about? This is the end of West. And people mock him for thinking, oh yeah, what a Luddite. He was so tied, to his old system. He couldn't conceive of how innovative it is to just be able to print money when the government now has its hands untied. And my response in defense of that guy is, well, look at what happened in the 30s and 40s. It's not obvious that we didn't see the end of Western civilization in some sense, okay? So, having said all that, the function of having gold reserves as of 1912 was that you needed to credibly convince the public and, the world financial community that your currency was worth what you said it was. And then what did that do? Why would governments want to ensure such confidence or to maintain such confidence? Is because it made it easy to have commerce with other countries. All right. So it reduced what's called exchange rate risk. Just like in the United States right now, it helps our economy that every U.S. state uses the U.S. dollar, as opposed to imagine if Florida issued its own fiat currency and Texas issued its own fiat currency and so on. And there were 50 different fiat currencies issued by the different states, and all of the transactions within each state were denominated in terms of that state's own money. And then anytime you traveled, but also if you bought something, you buy something on Amazon that was produced in California, and then you had to use, and you live in New York, and you had to do an exchange of your New York money against the California money, just for that simple purchase, right? That would get very difficult. It would make long-term planning difficult. Just like that was one of the benefits. There were costs too, so I'm not endorsing the Euro project, but that was one of the selling points of it back when the European Union, they all came together and said, we need to have a common currency, is they were saying it can't work if some German manufacturing firm wants to buy inputs from France, and then it wants to outsource and pay some technical workers in Spain to do some work, and then it's going to manufacture the things inside Germany and then sell them to Belgium, and we're using all different currencies. It's just hard for the internal accounting. Like, did we turn a profit? Well, geez, we got to keep track of these. And then even just besides the administrative problem, if the exchange rates move, right, you buy the inputs when the exchange rates are a certain way, then you go ahead and you make the product, you're getting ready to sell it, and oops, it's not that you misforecast the demand of the consumers and that. So, in World War II, by that point, all the countries are off gold. What emerges in the Bretton Woods system out of the ashes of World War II is what was called a dollar exchange standard. So loosely speaking, the U.S. government told other central banks and governments, hey, you don't need to stockpile gold. Just hold U.S. dollars. And when we say U.S. dollars, we also mean like treasury bonds. Okay, so dollar-denominated assets. Just hold those, and then we will promise we will redeem dollars for gold upon your request. Right? We're not going to do it for Joe Schmo, but the Bank of France or the Bank of England turns over dollar assets to us. We will give you gold. At this point, it was the price of $35 an ounce, right? Because FDR had devalued. Okay, and so that was the system that was in place in like the 50s and the 60s. And then you may know that Richard Nixon famously in 71 ended the dollar's convertibility to gold. And so that was the official end of gold backing up money on planet Earth. Okay. So what George Selgin is getting across in this blog post is he's saying once the countries had left the classical gold standard, now it's not as obvious what's the function of having foreign exchange reserves if everybody technically has a fiat currency. And basically he comes down and says on the conclusion that, for example, if you're some small country that's heavily dependent on international trade, that what you might do, even though you have a fiat currency, right? It's not backed up by anything. It's not that you have some pledge that you need to honor, but still you might want to minimize violent fluctuations in the exchange rate between your currency and that, say, of your biggest trading partner. So, right. So your little country has one type of currency. Your biggest trading partner has its currency. They're both fiat currencies. But maybe to make it easier for your people to import vital commodities, whether it's gasoline or natural gas or crude oil or whatever it may be, or maybe food like Hong Kong is extremely dependent on international trade, right? They import a lot of their food. And so maybe you want to make it so that your currency doesn't fluctuate too violently against that of some of your most important trading partners. And so how do you do that is you need to hold stockpiles of assets denominated in that other currency. For example, let's say there's a country, Argentina, like he wants to dollarize, right? So he wants to stabilize their currency. Ultimately, they want to make it so that they're just using the US dollar. But if they want to peg the peso to the dollar and say it's only going to fluctuate within this narrow band, how do you ensure that? You have to just start stockpiling US dollars, or you can have treasuries. A different example is China in the late 90s through mid 2000s. They ultimately announced a peg of the yuan to the US dollar. And so how did they maintain that peg? Is they started stockpiling US treasuries. And so that's why if their currency ever fell against the dollar below what they announced the peg at, they had a bunch of dollars effectively that they were owned that they could use to support their own currency, right? They would effectively go into the foreign exchange markets with their dollars and use them to buy Chinese yuan. And that would push up the dollar price of yuan back to where they wanted it to be. Okay, so that's the idea. If it went the other way, right, if their currency got stronger than they wanted it to be against the US dollar, well, that's easy to fix. They could just print more, right? But the idea is you can't print more of the fiat currency of other governments. And so if you want to be sure you can credibly say to financial market participants, our currency is going to just fluctuate in these narrow bands against these other currencies, you have to hold stockpiles of those other currencies. And again, when we say hold stockpiles of currency, it doesn't mean you literally hold paper notes. You can have like sovereign debt issued by their governments that has an associated yield. So you're not just literally holding cash. Okay, so Selgin's point is, okay, fine, if that's what's going on, but notice the one government for which that is not important is the United States government. Every other nation may want to be able to credibly show we can ensure that our currency doesn't fluctuate too much against the US dollar because we're the global reserve currency. But the US government doesn't need to show, oh, don't worry, we won't fluctuate too much against the euro, because nobody cares. It's people who use the euro and their own currencies might want to make sure the euro doesn't fluctuate too much against the dollar. But we don't need to care about that. And that's why Selgin goes on to argue in this essay, the US actually, if you look at it, has a very small amount of foreign exchange reserves compared to other countries. Okay, and then even a big chunk of the US official reserves are these special drawing rights that are issued by the IMF. And Selgin argues the US government's not holding that for strategic reasons. It's just like, given that it's part of the IMF and how much we contribute to it, that's kind of the formula that we have to hold that stuff. Okay. So again, he kind of just, with both theory and empirical data, makes the case that right now the US is not holding very much foreign exchange reserves for any strategic purpose, given the dollar's role in international trade. And the gold that we still hold is just a relic from the old era that no longer serves any function. And that's why Selgin is saying, yeah, I'm open to the idea of selling off the gold. But again, it's not to then swap it out and to buy Bitcoin. All right. So I think I accurately summarized what Selgin's point was. And again, he's not against Bitcoin per se. He's just saying the people saying, oh, this will strengthen the dollar or, keep it strong and serve as a superior reserve asset. Selgin's point is, no, the dollar does not need any. It doesn't have any reserve asset really right now because it's the global reserve currency. Okay. So that's Selgin's point. Let me just now wrap up by saying I'm generally okay with that line of argument, except for the following caveat, which perhaps is a big caveat. Yes, if you assume the US dollar is and will continue to be the global reserve currency, then I agree with Selgin. Therefore, it doesn't need a bunch of reserve assets backing it up, because that's kind of the point. No, the other people need to show that they can keep their currency pegged to the dollar, but the dollar is the standard. But if you think, as I do, and listeners to the InFi podcast know that I've made this case in different contexts over the last year at least, if you think, as I do, that the US dollar is losing its status as the global reserve currency, then you can't use that as a trump card anymore. No pun intended, referring to Donald Trump. Okay. And so I don't think it's wrong to say, given that the US dollar may forfeit its stance as the global reserve currency, the US government would be wise to bolster its backing, even though it's not literally a pledge that, oh, if you turn in this many dollars, you get this many Satoshis, with something that is probably going to outperform any other asset you could plug into the mix. Okay. So that's the quibble I would have with George's case. But other than that, I think reading his post is definitely useful just to give some of the historical background and understand the big picture of why the heck do central banks even have reserve assets in the first place. Last point I'll make is, if you caught it, when Michael Saylor, that clip we played, he kept talking about the world's reserve capital instead of the world's reserve currency. And I think he was doing that to show that this kind of reflects the evolving view of what Bitcoin's going to be for the financial community. When Bitcoin first came on the scene, people were touting it as, oh yes, this is going to be the new money. This is the digital money. It's going to replace the dollar. But then as the price per unit of Bitcoin started soaring and as transaction fees also rose, it became clear, and this is what the so-called block size wars were about, that since the small block community won those battles, at least thus far, the new vision for Bitcoin is not that you're going to go around and buy a cup of coffee by transferring a few Satoshis to the merchant on the layer 1 Bitcoin blockchain. That's not what's going to happen. Instead, now they're viewing it as like digital gold, and this is like the reserve capital. And so large institutions are going to be sitting on massive stockpiles of Bitcoins and then perhaps only periodically transferring them for major transactions or just clearinghouse operations every month or something to get square in terms of their other transactions that are conducted on higher layers. Okay, but in terms of day-to-day commerce for normal people, that's not what Bitcoin layer 1 is going to be used for anymore. So I think that's why Saylor now is not referring to Bitcoin as, oh, this is going to be the new global reserve currency, which is how Bitcoin fans used to think of it in the early days. But now I think that's why he's calling it, oh, it's going to be the global reserve capital. That if you're a wealthy company and certainly a government, how are you going to demonstrate your financial strength? What do you want to have on your balance sheet in terms of some of your pristine capital? Oh yeah, you want to show that you own Bitcoin. And so that's why he's saying the U.S. government needs to look ahead and realize the big boys on the block 10 years from now are going to be measured in terms of how many Bitcoins do you hold. Okay, so I will end there. I hope you have gained from this. And again, if you want to see this stuff spelled out more, you can go to the show notes page. This is InFi episode 68, and I'll have links to Selgin's posts and my post and the Saylor clip. Thanks for tuning in, everybody. See you next time.